Alright, hello and welcome to Camel Finance. I'm your boy Camel, and I want to start by pointing out that so far, despite this turbulence, investors haven't actually capitulated. This could change if the stock market takes another 10% hit, as the 2-year yield suggests it might. So I'm not going to go through this full thread, but I think it's time to start being mindful that we are teetering on the edge of a knife. So that's basically going to be the theme of today's video. Let's get into this. We've had another record broken. The number of central banks in a hiking cycle have reached its highest percent level since '82. So this is indeed a time for new records, seemingly all the time. The S&P is currently mirroring exactly what happened in the 1940s. The indicators suggest that the S&P 500 is facing a new cycle low of 3,500, producing a drawdown of 27% versus the current 25%. It would be exactly in line with 1946 post-World War II analog. So you can see from this that we possibly don't have much more of a drawdown to accomplish finding a low. However, there's a good chance, according to this, that we will sweep the low. That remains to be seen. I wanted to point this out, that we had the PMI for the United States yesterday, and I've put boxes around this, but I've copy and pasted this onto the next page, so I'll just show you that here. The US S&P Composite PMI was 49.3, which was above the forecast and above the month before. And the manufacturing PMI was 51.8, above its forecast and above the month before. So the PMI is of course measured from 0 to 100, with a reading below 50 indicative of a contracting economy. Of course, a reading above 50 is indicative of an expanding economy. So the PMI readout as of Friday is hinting the economy is stronger than expected. Manufacturing PMI is expanding already, and the composite is almost expanding, as you can see, not very far off. This suggests the economy might actually be able to withstand further tightening. And so I have a question for you. Were you paying attention at FOMC? Do you know what this implies? Powell told us at FOMC that this significantly increases the chance of a hard landing. A strong economy significantly increases the chance of a hard landing. So stocks could be brutal this week. And I've made myself a note here. I said Dow nuance 80%. So I'm going to show you something, share a bit of alpha with you right now. This is the Dow Jones. First thing to point out is the Dow Jones has taken out its low. So there's some divergence here because the NASDAQ did not take out its low. Okay? And neither did the S&P. So as you can see, very, very close, but didn't take them out. So the first question is the Dow leading, or did the Dow jump the gun? That remains to be seen. The reason I put this note here to explain the Dow nuance. If you have a Thursday's close on the Dow, which fails to take out the high of the Wednesday, like here, and then you have the same thing play out on the Friday, where the Friday's candle fails to take out the high of the Thursday, like it has here. There is an 80% chance, or said a better way, 80% of the time, the Dow will open lower on Monday. So we've got an 80% likelihood. In 80% of cases, it would be completely normal for the Dow to open lower on Monday. So lower than these lows, lower than this candle here. That would be an interesting scenario, and I wonder how the NASDAQ could possibly, under those circumstances, hold its low. And the same is of course true of the S&P. So does this mean we are looking for shorts taking out these lows? Well, quite possibly. You certainly need to be open to downside. Britain's economy is now officially in a recession, as confirmed by the Bank of England. And the UK is talking about reducing taxes on crypto to promote growth, according to Matt Hancock. So is this wishful thinking? I'll believe it when I see it. I'm certainly not getting my hopes up, but that would be nice, wouldn't it? I've got here something that I've shown multiple times on this channel, where the Bank of England's talking about moving the goalpost for inflation. They have their initial 2% target, and now they're saying, or they have been saying, that perhaps this isn't reasonable and 4% may be more in line with reality. So why am I showing you this again? Well, because according to Janet Yellen, the US Treasury Secretary, as of yesterday, the 2% target might not be achieved in 2023. So are they prepping us for this new normal? Are they going to talk about moving the goalposts early next year? I think quite possibly they will. All of this is going on at a time when the fiat currencies are collapsing right before our eyes. The euro has fallen to $0.98 for the first time in 20 years, as Deutsche Bank forecasts longer and deeper recessions. The euro is at a 20-year low. The yen is 24-year low. The pound is at 37-year lows. We are literally watching the collapse of the Ponzi currencies into hard currencies. First, all fiats collapse into the USD because the USD currently holds the world reserve status. This is why the Dixie is bid, because everything else is getting crushed faster than the dollar. But don't get it twisted, the dollar is indeed dying as well. We are watching the collapse into the dollar, which is why the Dixie is spiking. The next step is that the confidence will be lost from the dollar. We're already starting to see this, as I've shown in my other videos, where we're getting overseas investors, Saudi sovereign wealth funds, China, Japan are selling US treasuries because they are losing confidence in the dollar. We're already starting to see this, and the final step is that once confidence is truly lost in the dollar will collapse into the true hard currencies on the planet. In this case, Bitcoin and of course gold. Gold and Bitcoin are the two hardest currencies on the planet. After the halving in 2024, Bitcoin will indeed be the hardest currency on the planet. So remember, all assets go down when interest rates rise as fast as they have been in 2022. That includes stocks, bonds, real estate, gold, even Bitcoin. Absolutely everything goes down during aggressive rate hiking cycles. But the decline will not last forever and will probably reverse suddenly. That's at least usually what happens. So what do you think the trigger for the next pump will be? If you've got any idea, throw it in the comments. I'd love to hear. I think we could see Japan dumping US treasuries. They could be forced to defend their yen, which is of course at multi-year lows, as I just shown. Where was it? Back here. The yen is at 24-year lows. Are they going to get sick and tired of this? Are they going to want to defend their currency and perform yield curve control? And the way they would do that is to dump US treasuries. This could put downward pressure on the dollar. And of course, downward pressure on the dollar could lead to a turn in risk assets. Shockingly low CPI print could well be the trigger. We've had 3 months in a row now of lower CPI. Whilst core was up in the last month's print, CPI is down, albeit marginally. So imagine a scenario where we got a 4%, a shock low, one that no one's expecting, which just comes in next month at 4%. What would that do to risk assets? Well, that would signal to the market that the Fed has accomplished its mission, that inflation is falling off a cliff, and therefore we could expect to see them pause and be more accommodative to markets. Something else that could catalyze the low is a pivot to a pause in rate hikes. This was kind of hinted at FOMC. If you didn't watch my FOMC video breakdown, go and watch that, because I covered that in detail in there. But ultimately, the Fed kind of is telling us that at least for the rest of the year, they're thinking about essentially 1 or 2 more rate hikes for a total of around 100 to 125 basis points. So if they could signal at the next FOMC when they are planning to pause rate hikes, I think that could also put a bottom in risk assets. And of course, it could be something completely different. There is huge divergence between CPI and Brent crude. CPI has some downside catching up to do. So you can see that oil's been coming off very strong, and CPI, not yet. So imagine if this was to print down in the 4% range. I think that would put a bottom in markets. Now, I'm not saying I expect it to print in the 4% range, but there are multiple indicators suggesting that the next CPI print is going to be significantly below 8%. Meanwhile, if you love Bitcoin, then you want to keep a close eye on this, because the R-HODL ratio leaves the green zone. Whenever that's happened in the past, that has been the catalyst for a Bitcoin bull run. So we've entered this green zone. We tend to spend a little bit of time consolidating in this green before emerging, and once we emerge, that usually catalyzes a massive upside move for Bitcoin. At the same time, the short-term holder and long-term holder cost basis is about to cross, only around $100 apart on last night's close. Historic bottoms always fell within days of this crossing. Meanwhile, Singapore's largest bank is going to offer Bitcoin to 100,000 more clients to meet increased demand. And seeing this here, increased demand, begs a question in my mind. How is it that the stocks are coming off so strong, but Bitcoin has been holding strong like a champion? Now, it's not to say Bitcoin couldn't break down. Of course, everything is on the table. It's certainly a possibility. But I can't help but notice that in the face of a melting stock market and a very strong dollar, Bitcoin is net sideways since its low and is still not yet taken out its low. I think that speaks to increased demand, and we're seeing that at least here with Singapore's largest bank offering Bitcoin to even more clients. Stripe is enabling payments in USDC for freelancers in over 110 countries. So again, we're continuing to see the space be adopted. We're continuing to see all of these sorts of things be rolled out. The dollar is on a 113 handle as of the time of recording. Absolutely blasted through this really old support. Where's the weekly chart? If I go back here, so you can see, you know, we've not touched this since the 2000s. So the dollar is a dollar wrecking ball at the moment. I expect this is going to continue until the Fed signals that it's done. As I've shown already, the stocks, there's some divergence here. So I would think either the Dow is going to pop back up, or potentially more likely, since we know with 80% confidence, as I already told you, that we're going to open lower on Monday, I think we can expect the Nasdaq and the S&P to take out their lows. I think it's time to look for shorts on Monday. So that's something I'll be preparing for. If I open any shorts, I'll be sure to notify you on the channel. So if you want to see me do that in real time, make sure you hit that subscribe button. Just noticing oil has lost its 80 handle. So making our way down to target. I expect this to continue. Gold, we are officially short. I know I don't like to take positions on a Friday. I know I don't like to take weekend risk. However, I needed to hedge my pension position. I have an enormous amount of gold held in my pension. I've lightened that up since we've lost this low. I have a new game plan for gold, which involves buying the cycle low, the weekly cycle low, which is not due till the end of the year. So how low that comes down, I don't know. Even if it comes higher, it doesn't really matter, because I had to de-risk because I had so much exposure to gold in my pension. So I've de-risked massively in the pension account, my long-term accounts, and I have opened a short here to try to recoup some of the loss from the pension position. So that's that. Ordinarily, as you know, don't take weekend risk on, but I think this is an exceptional circumstance. Like I say, this is more of a hedge than a trading position for me at the moment. So that's that. Silver, likely going to bleed lower, of course. And silver miners, we are finally out of these positions, so I'm glad to see the back of them, to be honest. That's great news. We've got a short on gold. That's fine. I did flag this well in advance, so that's good as well. The Bitcoin position, Bitcoin, like I said, still holding its lows, still kind of sideways. I expect nothing exciting for a while. I really don't want to see us lose these lows, because I think that puts in enormous structural damage. But I think whilst we're chopping around in here, that's absolutely fine, and then we can look to load up in this 60-day cycle low. Exactly the same is true of Ethereum. I think chop around for a bit and then load up at the 60-day cycle low. XRP, I've drawn this line here because this would be an ad for me if we can get above here. I'll go back and try to show you what I mean. When XRP goes on one of these big moves, where's a good example of this? So here you go. We get a breakout, a bull flag. I like to mark the highs here. So that's taking this wick here, draw a line. When we cross that line, you can add to a position and move the stop to the whole lot under here. Then as it emerges, another little ball flag, you can draw a line here and go again. So that's kind of what I'm hoping to replicate. You can see that would have worked back here as well. So you get the breakout, the ball flag, you draw a little line above the high of the wick, and then when you cross that high, you add to your position, move your stop up to this range, and then try to push some more out of the trade. So that is my plan if we can actually get above this line. So if we sort of ball flag in here and break out, we can add here, move the stop up to wherever it goes. That's fine. I think I said in my last TA video that I was going to take the risk off. So I've just moved this all the way up to break even in my account. There's no reason to accept any risk on a trade like this. I mean, we're up, where are we from our initial entry? We're up, you know, 50, 60% and at least 37%. So there's no point in giving that back and letting it go negative. We added to full exposure on a break here as well. That was called in real time on the channel, so that's fine. I kind of see a couple of scenarios possibly unfolding for this trade. I think the max pain scenario would just be that we do this and come back down. That would be annoying, but trades fail, happens, right? That's why I don't want to accept a negative loss on this and why I'd be cutting for a little bit of profit if that was to occur. My preferred scenario is that we kind of ball flag for a bit and then break out, and so I'd be adding on that breakout there, as I've already mentioned. And then the other scenario that I could see is a back test of this blue line before going. So that would be okay. If we get back here and hold, then as we emerge, we can add there as well, or just hold and move the stop up to wherever that swing low forms. So those are the three scenarios I see for this trade. That's how I'm going to be trying to approach this. It would only really suck. The only one that would suck is this one where it goes straight down. But if we can get a bull flag and a breakout, we can add. If we can get a retest and resumption, we can add and move the stop up, and then be targeting at least sort of 0.9, I would think. And interesting look from the yields, but still rather strong, aren't we? So is this going to hold? We've got a good breakdown indicator. This is a very, very well established and clean looking trend. So a breakdown of this line here would likely call the top in the yields. So that remains to be seen for now. Keep an eye on that as always. I hope you found value here today. If you did, I'd appreciate it if you could drop a like on the video. Subscribe if you're not already. Throw something down in the comments for me to read. Or if you have any opinion, I'd love to hear it on anything. If you want to see anything from me as well, you can let me know via the comments. Follow me on Twitter if you're not already. And I hope you enjoy the rest of your weekend. All the best from me. Take care. Cheers. Bye.